Well, it's finally happened. Michael Burry is back, and he just made a big bet against the US stock market. If you don't know who he is, Michael Burry was one of the few investors who predicted the housing bubble before the whole market collapsed in 2008. And he ultimately ended up profiting over $100 million personally and making over $700 million for his investors off of that trade. So if you've been watching the markets at all in recent years, you've seen the continued rise in indexes like the S&P 500, which has hit a new all-time high 50 separate times in 2024. So a lot of investors are thinking this can't keep going up forever, right? Well, they're not alone, with many famous investors either asking the same question or even selling huge amounts of their stock positions. And Michael Burry in particular is interesting since he's correctly called every last major stock market crash. He shorted the dot-com bubble in the early 2000s. He famously predicted and profited from the subprime mortgage crash that kickstarted the Great Recession. He made a fortune shorting Cathie Wood's ARK Innovation ETF during the tech crash in 2021. Love him or hate him, this guy has made a lot of money off of his market predictions. But after deleting his Twitter in 2023, Burry has gone silent on the markets, at least publicly. But we can get an indirect look into what Burry is thinking by looking into the SEC filings from his fund, Scion Asset Management. So let's see what stocks he's been buying and selling and see if you can spot the pattern. Sale, the RealReal Inc. Sale, American Corporate Ins Corp. Okay, interesting. Buy, Alibaba. Buy, Baidu Inc. Buy, JD.com. And he had a bunch of puts. Remember, these reports aren't in real time since these are Burry's trades from last quarter. But what do all these stocks have in common? Well, they are, all of them, Chinese stocks.
China.
On the Chinese economy.
The Chinese economy.
And the sales, American stocks.
The reality is inflation remains high.
Trump will be the 47th president. Growing concern that inflation could actually take even
The Fed's
higher.
job is likely not done.
Okay, wait. That doesn't necessarily mean that Burry thinks that American stocks are overvalued. Maybe he just really likes Chinese stocks. Maybe, except for before Burry deleted his Twitter, he left us with the exact warning signs to look for before the next stock market crash. And it looks like he's acting on those signs, both with his sales of US stocks as well as his strategy of buying and hedging his Chinese bets. So let's look at what Burry might be seeing in the market and, more importantly, what you can do to protect yourself. Back in 2019, Burry issued a warning about a bubble brewing in the ETF market, saying that passive investing was artificially inflating the values of stocks, just like CDOs had inflated the subprime mortgage bubble in 2008. But investors at the time mostly dismissed him, with Elon Musk comparing him to a broken clock, and Twitter users saying Burry had predicted 6 of the last 0 stock crashes. Even Tom Nash got in on the fun. But after a crash caused by the pandemic in 2020, followed by an even faster rise in stock prices, it started to look less like Burry was wrong and more like Burry was just too early. It wouldn't be the first time. The housing market didn't crash until 2008, but Burry was predicting that crash way back in 2005. And now, 5 years later, there's something happening in the US stock market that is causing Burry to sell his US positions. And it all centers around this idea of passive investing. Okay, so passive investing, there's really only 2 ways to do it. You can buy an index fund, or you can buy an exchange traded fund, or ETF for short. If a single stock is like an ingredient in your portfolio, an index fund is like a grocery basket that contains all the ingredients you'd need to cook a recipe for the entire market. You buy every ingredient, or in this case, a little piece of every stock, in the market that the index tracks. So for example, if you're tracking the S&P 500, you could get little pieces of the 500 biggest companies in the US. ETFs, or exchange traded funds, are similar, but they're like ready-made frozen meals. They give you a bunch of stocks in one purchase, but unlike index funds, you can buy and sell ETFs throughout the day. So both index funds and ETFs make it easy to invest without picking individual stocks, and common wisdom has been that slowly investing in ETFs and index funds over time is the best way for most investors to grow their money.
You said in the 1996 annual report that most investors will find that the best way to own common stocks is in an index fund.
So I would pick a broad index, but I wouldn't
toss a chunk in at any one time. I would do it over a period of time.
And the idea of passive investing makes sense. The average active trader will end up with average results, but they also have to pay extra fees for trading or management. So by investing in every single stock in the market through something like an index fund, you can get the same average returns, but without all those extra costs. This style of investing really took off in 1976 when John Bogle introduced the first index fund for Vanguard, but it has absolutely exploded in popularity recently. Since the 1970s, the percent of adults who are invested in stocks in general has steadily increased. Here's an article the New York Times published in 1975 reporting that just 25.2 million people owned stocks at the time. But today, that number is closer to 61% of Americans, or over 230 million people. So more investors than ever are jumping into the stock market, and the amount of them investing passively is also growing. And it's this combination that is making Michael Burry so worried. Here's a chart of the amount of money invested with active funds like hedge funds or mutual funds over time. And here's a chart of the amount of money being passively invested. So you see that point on the top right? Passive investing has grown in popularity so quickly that for the first time in history, passive investing has surpassed every active investment in the market combined. And this has more than just Michael Burry worried. If the market is mostly owned by people who don't care about the specifics of the stocks they buy, what effect does that have on market prices? Well, here's what Charlie Munger, Warren Buffett's right-hand man, has to say about index funds in that same clip from earlier.
Common stocks could become so high priced that if you bought index funds, you wouldn't expect to do very well. I didn't think I'd live long enough to think that was likely to happen, but now I think that may happen.
So this clip really got my attention. Like, this guy isn't like Michael Burry. Charlie Munger is one of the most conservative investors out there. So I dug deeper into why these big investors are so worried. And the big thing that comes up is something called price discovery. So if you think of a stock, let's say Apple, the price of the stock should be whatever the market on average is willing to pay for it. But this concept of price turns out to be a very fickle thing in the stock market. So price discovery. Imagine you're at an auction and someone is selling a rare baseball card. The card's price isn't set by the seller, it's decided by how much people are willing to pay for it. Some bid low, others bid high, and the final price reflects what the group thinks the card is worth. And for stocks, this happens every second the market is open. Buyers and sellers look at things like company profits, new products, or the economy to decide what a stock is worth. And this back and forth is what keeps stock prices tied to their real value based on what everyone knows, wisdom of the crowd. But now with passive investing dominating the market, this price discovery process could get broken. When you buy an index fund or an ETF, you're not checking if every single stock is worth the price, you're just buying the whole basket. So if a stock is part of that basket, people are willing to buy it simply because it's in there, not because it's necessarily a good investment. For example, Apple stock might be worth $200 based on its business. But if billions flow into funds that include Apple, its price could rise to $250 just because people are buying the basket. And that extra $50, it would be artificial demand, not tied to the stock's real value. So, okay, maybe passive investing is pushing prices up, but passive investing has existed for a while, so we need to look at what has spooked Burry into selling now, figure out which industries could be the hardest hit if a bubble bursts, and most importantly, how regular investors like us can protect ourselves. So why, after 5 years, is Burry selling now? Well, a lot of investors are uneasy about how much the stock market has grown. I mean, look at a chart of the S&P 500. It's up nearly 90% over the past 5 years. But that big growth hides a bigger problem, which has only gotten worse in the last 12 months: concentration risk. So here's the official definition of concentration risk. When your portfolio is too focused on one type of investment, you can lose a bunch of money if that one investment goes down. It's like a group project in school where just 1 or 2 people are doing all the work. So if those people stop working, the whole project can fall apart. That's what's happening right now in the S&P 500. A huge chunk of the S&P 500's growth is coming from just a handful of big tech companies: Apple, Microsoft, Amazon, Nvidia. According to Goldman Sachs, the top 10 companies in the S&P 500 now make up a third of the index's value. That's even more concentrated than during the dot-com bubble of the 2000s. So now, if those few companies run into trouble, it could drag down the entire S&P 500, even if the other 490 companies are doing fine. So how can a normal investor avoid that risk? Well, The best tool to counteract concentration is diversification, spreading your money out across many types of investments. This way, if one area struggles, the other might hold steady. So let's look at some options that people talk about to diversify. So first, maybe we can invest in crypto like Bitcoin or Ethereum. People often talk about these investments as a store of value or a hedge against inflation. And inflation is definitely hitting people's wallets even after some cooling in the economy. But here's the catch. If we look at the correlation between Ethereum, Bitcoin, and stocks, we can see that they've become more connected over time. So while it's exciting and volatile, when stocks drop, crypto usually drops too. Okay, so maybe real estate. Well, it can offer some protection, but over the years, the real estate market has started to move more and more in sync with the stock market, making it less of a safety net during crashes. So okay, let's leave the US and look at Chinese stocks, where Burry has been putting his money, specifically in Chinese tech stocks. So China's government has recently been pumping huge amounts of stimulus money into their economy, nicknamed the Chinese stimulus bazooka, because they're basically saying, we just want growth at all costs. This has some echoes of the US stimulus from the early 2020s, which fueled a massive stock market rally, especially in tech, along with a bunch of inflation. So Burry may feel that US tech stocks already had their pump cycle, and now he's moving on to China as they start to follow the same path. But taking everything together, if there really is a passive investing bubble in the market, let's look at what regular investors can do right now to protect themselves. So let's look at this from first principles. If Burry is right and a bubble is getting ready to burst, we only have a few options available. Option 1, we could sell our stocks and go into cash, but that's probably the worst option overall. If there is a big market crash, especially if a recession comes with it, the Fed is probably going to do something. Generally, in a recession, the Fed will lower interest rates to stimulate the economy. But when interest rates are lowered, that increases the amount of money flowing through the system, which causes higher inflation. So anyone who goes to pure cash would see their money very quickly get whittled away by rising inflation. I know I've seen the effects of inflation every week when I go grocery shopping. And when inflation is high, staying invested in the stock market is one of the best ways to avoid losing money to inflation. So option number 2, we could try to time the market, selling out before a potential crash and then buying back in at the bottom. So Charles Schwab actually ran a study about this sort of strategy, comparing 4 investing styles over 20 years. They had 4 people, person A, B, and C, who each invested once per year for 20 years straight. Person A perfectly timed the market by buying at the bottom each year. Person B just invested consistently on the same day each year. Person C had horrible market timing and bought at the peak of the market every year. And person D just stayed in cash and bonds. So Charles Schwab simulated the results of each strategy over 20 years, and the results were pretty clear. Staying in cash was by far the worst, but the left side was more surprising. So if you had perfect market timing, you only made yourself around 8% more than just investing consistently over 20 years, while bad market timing cost you closer to 12%. And this is a simplified version of what many in-depth studies have shown. The potential win from timing a market crash successfully isn't worth the risk of timing it badly. You lose more than you win, and you lose more often trying to time it. So your best bet is just to invest consistently. But let's look at option 3, which is what I will be doing in the case of a market crash. First off, I probably won't be buying Chinese tech stocks because 1, there aren't as good regulatory protections for Western investors in China, and 2, unless you have Michael Burry's perfect timing, buying Chinese stocks is actually very correlated with buying US stocks. So it doesn't protect you in a crash. If US stocks drop, these stocks will probably drop too, and they're more risky due to different regulations. Instead, what I am going to be doing is a mix of putting around 15% of my income into a passive broad market index fund, which has consistently been shown to be the best way to retire with money. Now, as long as I don't need to pull any of that money out in the next 5 years, investing over a long time horizon helps reduce that concentration risk in these big tech stocks. And second, I'll continue to buy undervalued stocks with a 5 to 10 year time horizon with any extra funds I can scrape together, because consistently putting more money into the market is the best way to build wealth, and time in the market beats timing the market. But then there's the other case where Burry is wrong and there is no bubble. Well, in that case, consistently putting money into the market also works. Like in the last 5 years, people who stayed invested in the market made far more money than anyone who sold back in 2019. Now, it is interesting what Burry is seeing in the Chinese economy that is making him put those new hedges against his Chinese stocks, but that'll have to be the next video. My plan for now is to keep it stable and keep it invested. A broken clock is right twice a day. Still more consistent than my YouTube schedule.